G'day to all the clients of Apex there. Welcome to your March quarter update. Shooting this one in April, so we'll slightly straddle into the new quarter. Over the next sort of 5 or 10 minutes, we're going to walk through some commentary on the quarter and then a few key and a few great graphics I've come across this quarter to put things in perspective when it comes to your investments. So with regards to the first quarter, the headline for the quarter is the geopolitical risk continues. In 2025, we saw that it was the trade or tariff wars launched by the USA that caused lots of volatility. And then this time around, it's the Middle East conflict and with the USA striking Iran or invading Iran. Now, that uncertainty has sent shockwaves through the global economy and stock markets, and that has led the stock market to fall and be sold off through the March quarter. And that sell-off's been in the mid-single-digit range, so 6-7% negative. Now, on the ground, what are we noticing? We're noticing higher oil prices and its effects there at the Bowser. And we're seeing supply shocks starting to flow through. And that's all culminating in inflationary pressures here, particularly in the stock market. So what we do know is that, interestingly enough, the market has priced a lot of this negative information in already. So what we're seeing news-wise is already priced into stock markets. We've seen a strong rebound in the early part of April as the news flow starts to turn positive, and as that bottom dot point outlines there. Now, when it comes to more locally, there was a rate hike here in Oz in March, as inflation seems to be a bit stickier than the central bank would like to see. And globally, there's a bit of a hawkish tilt with central banks as inflation is hanging around a bit higher more than we'd all hoped. More globally, looking under the hood of the stock market, moving the Middle East conflict aside, we actually saw a bit of a sell-off in the tech sector in the States. So last year, the narrative was all around AI and how it's going to help us innovate and what's that going to help us do and what can that do for me, to now turning the question around which companies is AI coming for. So that's led to a market, what we call a leadership broadening. Essentially, a lot of the tech companies have passed the torch on to other industries and sectors in the stock market to lead it a bit higher. So thinking defense companies, we're thinking banks, and we're thinking commodities led by oil prices. Remembering that a decent recovery has started in March as we record this in April today. So we want to look through the prism of the Vanguard High Growth Index to give us our results. So the stock market performance for the March quarter, because this is a really good proxy, remembering for global share markets, we saw on the screen here a negative 5.14% return for that quarter. And year to date, negative 3.14. Interestingly enough, if we zoom out to 1 year and 3 years, we're sitting double-digit returns above 11, which is really good, and the long-term returns sitting in the high 8s. So that puts things into perspective. And then a bit of the breakdown of each individual indices within this. So the S&P 500 we see as negative 4.6, the Euro Stock 50 negative 3.8, the FTSE in London up +3. Locally, we're down just 1, and this helps us understand that diversification really does matter. Now, this chart here on the screen is the S&P 500 over the last 12 months. You can see the sell-off on the right-hand side and the start of the recovery for the quarter as the more positive news flows. Now, this graph I found somewhat interesting. So noting that at the moment we have a oil shock, so a surge of an oil price of over 20% over 2 days. In this instance, it's particularly caused by a geopolitical conflict between the US and Iran. Now, that shock, oil shocks, wars, pandemics, and political events have occurred repeatedly historically. But this particular one, where an oil price has surged over 20%, has happened 8 times since the mid-80s. And what you'll notice on the screen here is that within 12 months, the Standard & Poor's, the US share market, has on average been up 24% within 12 months post that 2-day surge. And the one time it hasn't been a positive was this one here, which is the middle of the GFC, where there's more than a one-speed thing happening there. It wasn't just a geopolitical thing. So this tells us that this is not new. Middle East conflicts, and there was a Russia-Ukraine one there as well. It's none of this is new. We've seen this before, and the share markets climb that. And so that's what the question then becomes: what should I do? What does this mean for me? There always seems like a good reason to sell on investment markets. It never feels comfortable seeing the headlines that we're seeing. But historically, it's been proven and shown that these headlines do come and go, and the stock market will typically climb a wall of worry given that the time frame's right. So the chart here, which you'll see, is from the year 1995 to 2025, so a good 30 odd years. And the stock market's been incredibly strong over that period. And that's included things such as the trade war with the Trump trade war with the US, the Russia-Ukraine invasion, COVID, and all those other line items you can see there on the screen. And this just shows us that the stock market typically climbs a wall of worry. And we believe this period is no different, no matter how uncomfortable it feels. Now, this table here, I want to focus on this bottom line here. And this chart tells us that the best days on the market closely follows the worst days. So over the last 20 years, the best days on market have occurred within 1 month of the worst day. What we're seeing right now with the negative headlines and uncertainty, we're seeing the stock markets fall back and we're starting to see that strong recovery. Okay. And this one's also really interesting. So that means, based off what we said, is that it's being invested, and staying invested is more important than timing, i.e. I'm going to sell when it's high and buy when it's low. And no matter what anyone says, none of us have a crystal ball. The key to having long-term success when it comes to investing in share markets is to stay consistent and remain invested. And here, this just is a worked example. It just shows if you invested $100,000 in the S&P 500 index 20 years ago, and if you just left it invested, you'd have $717,000. Had you missed only the best 5 trading days over that period, your return falls all the way down to $452,000. And all the way on the right, if you miss just the 25 best trading days of that 20-year span, you end up with only $158,000. So we don't know what tomorrow brings. We do know that strong returns follow negative returns, and they typically follow periods of uncertainty. So staying vested is more important is the most important thing. And just one more here. I particularly like this graph. This just shows us the probability on the US share market of getting a positive return. So if your time frame is for 1 day, it's a 60% chance your money will go up or down. And as such, given that, we may as well, if that's your investment time frame, we may as well go down to Crown Casino and have a punt. If you extend that out over 1, 3, 5, 10, and 20 years, you can see the probability of your money going up is really high. And the question, what else should I do? Is just ensure your time frame of your goals is up to date, and it's aligned with your investment profile and your investments. Continue to invest and reach out to your advisor and advice team if you have any questions or concerns. Thanks, and that's your March quarter update. Be in touch if you've got any questions. Thank you.